At independence, as I look at it, the Indian rupee was, much stronger in comparison to the US dollar than it is right now. $1 at that time was worth just over 4 rupees. Around the turn of the century, the dollar was worth about 45 rupees. It is much more than that right now. What's causing this depreciation, and why have we seen a depreciation over the last several months? Shalini Sekhri, who is Chief Executive Officer of Cosmos Capital, is joining in to tell you more. Shalini, why does the Indian rupee, or why is the Indian rupee depreciating against the USD? And thank you so much for taking the time.
Thanks, Alex. Good to be here as always. Currencies, just like commodities, fluctuate owing to their demand and supply. Now, the US dollar, as we all know, is the most traded currency in the world. And most currencies are benchmarked against it, including the Indian rupee, right? So it remains what we call the anchor currency or the reserve currency, mainly because countries have accumulated so much of it, and it is still the most stable and liquid form of exchange. We use it for international trade and transactions, international investments, many aspects of the global economy. Now, no single institution really is able to control the rupee exchange rate, right? Not even the Reserve Bank of India. And it's actually determined by a whole set of demand and supply forces. Actually, the currency market is extremely complex. But let me quickly take you through what are some of the important things that affect it and why are we seeing such a sharp depreciation in our currency right now. So generally, when we look at the rupee versus the dollar, we will see that it is affected by things such as economic fundamentals of the two countries, inflation rates, differences in the interest rates of the two countries, obviously political stability and risk appetite amongst investors. So all of these lead to this whole complex set of demand and supply that's going on. And if I talk about the top 2 or 3 things that actually result in why our exchange rate is depreciating, we'll understand why the situation is where we are at today. One of the largest factors, Alex, is oil imports. As you know, India imports almost 80% of its oil requirement, and that is the biggest dollar demand in India, basically to put its oil import bill. India's bill, you will be shocked to hear, has doubled in 1 year alone to 120 billion, in the recently passed financial year. So that's a huge amount of dollars that India requires. The other demand for gold purchases is where really there is a demand for dollars. Indians, as you know, are massive consumers of gold. And as a result, that we import and we have to pay dollars for that. So that continues unabated. We also require it for foreign travel, medical treatment, international education for kids, and all of that. Supply side, we have exports, we have foreign investments that typically come into India. But as you know, right now, we are seeing a huge risk-off sentiment and a massive outflow of dollars from India going abroad. This is sometimes buffered up by NRI sending money into India. And also when Indian companies borrow abroad, because it's much cheaper, there's also a supply side to the dollar. But as we have just discussed, the rupee has depreciated sharply. We are today hovering at about, close to the 78 mark. Depreciation in itself is not always negative. For example, you get better payments for your exports, more money in hand when you remit money into India. If you're, say, living in the US, you're sending money to, relatives here. The most important, I think, benefit really, if we were to look at the depreciating currency, is that you get a better performance for your international investments.
To that in just a bit. I want to come to that in just a bit, Shalini. Sure. But I want to talk a little bit more about the context. A couple of things here, right? You've had the dollar index that has strengthened quite significantly over the past few months. I guess that relates to the statements that have been made by the Fed, both in terms of unwinding of easy monetary policy and the reduction of its balance sheet. So that is also playing a part. And like you mentioned, the capital flows in and out of India. Right now, capital flows out of the equity markets here in India. But I'm sure a lot of people who read the pink papers will be asking, doesn't the RBI step in and curtail the fall in the rupee? What does it have its huge forex reserves for? Why does it not use that? Would you be able to comment on that?
Sure. So India has extremely healthy forex reserves. I think we're seeing crises in, say, countries like Sri Lanka, who've run out of money to pay for fuel, right? So fortunately, we continue to have an extremely strong currency reserve. Now, India is, for a long time now, been largely what we call a free float currency. You have pegged currencies, for example, the dirham is always linked in a particular ratio to the dollar. However, Indian currency is not so. The RBI, for example, while it does intervene occasionally, but largely we have seen that India has been left for the rupee to be, in a sense, what we call a free floating currency, which means that there is, market forces that would largely determine where the rupee dollar exchange rate is. And there are many times, like I mentioned, Alex, where it is actually beneficial also for the currency to depreciate because it makes our country extremely attractive. So there are, many reasons why the RBI would not intervene beyond the point. There are times where, we do see some intervention, but largely I would say, we are an open market and the currency really does find its level. As you rightly mentioned, just to summarize the 2-3 big trends that we're seeing now, our oil bill has gone up dramatically on the back largely of the Ukraine-Russia conflict. So we're spending so much more, dollars to buy oil. So that is weakening our currency. We are also seeing this massive outflow on the back of risk-off sentiment that we're seeing in global markets. And this is also partly your typical flow of money, from weaker currencies to the dollar as the Fed increases its interest rates. So for the first time since 2019, we are seeing that interest rates have actually started to go up in the US, which means that this is a safe haven currency, a safe haven country where you're getting better yields on your investments now because actually interest rates are going up. And this is a typical cycle that we see where money moves from emerging markets to, the developed markets as their currencies appreciate and interest rates go up. So that's really, a very traditional play that we are seeing, repeated now.
Now, let's get into, and also to the point that you were making in terms of the free float, which is what I wanted to drive home, which is why the RBI has come out repeatedly to say that we don't want the rupee at any particular level. We will step in when we see too much volatility in the Indian currency. But let's talk about the implications for the individual, for you and me, and for the average Indian. You pointed out certain benefits, but I guess before that, we should talk about the implications first.
Sure. So if you talk about what happens to people like you and me, right, this actually reflects into much higher prices for everyday goods. And that's because as the rupee weakens, it costs India to pay more for its imports. Like I said, especially crude oil. We've seen, the prices of petrol and diesel shoot up tremendously. And besides, of course, what that means for our personal inflation, it also means that every person who uses transportation, including businesses, have to increase the cost of their products, right? So accordingly, we are seeing that we are at pretty much 8-year historic highs in terms of the retail inflation. It's at about 7.8% in the last quarter. And that's pretty much the highest in the last 8 years. And if I were to just look back, not long ago, maybe 4 or 5 years ago, diesel was 57 rupees to a liter. And today we're talking about it at about $100. So clearly, I think with everything that's going on in the Ukraine, etc., oil bill is something that's, affecting all of us tremendously as we live our day-to-day life. Secondly, coming to the interest rates in India itself, right? So as there is inflation, because the price of all these commodities and products is going up, the Reserve Bank of India has to also start to raise interest rates, largely to suck out excess liquidity that's floating around in the system and beat inflation, or at least combat inflation. And that's where really, as interest rates rise, we will see this getting reflected in higher interest rates on all the loans that we have, including our home loans. So we can expect as individuals that our home loan rates and our EMIs will go up. Various other things which are, less critical, but foreign trips become more expensive. Even if a hotel room is $100, 3 years ago we paid 6,500, and today we are paying, more like 8,000 rupees per night for that same hotel. Medical expenses go up. That's largely because a lot of our high-end medical equipment is imported, and we have to pay more rupees to buy, the same medical equipment. Medicines as well are imported. We end up paying more. And I think lastly, something that affects many of us is that foreign education will cost more. to pay the same tuition fee, we are now spending more rupees to the dollar, to send our kids abroad to study. So these are some of the ways in which, we see what we call imported inflation, where, the currency and what's happening with the rupee depreciation actually hits us very close to home.
This show has a lot of people who are looking at it from the perspective of investment. So let's talk about that. And that really is the crux of today's conversation. How can investors benefit from a depreciating Indian rupee?
So Alex, if you recall, on your show before, we've talked about many ways in which Indians can send money from India through the LRS route to invest in various opportunities overseas. Now, the common factor across all of them is that the first step is that your rupees from India get converted into dollars, go overseas via your bank, and then get invested into investments of your choice. After a couple of years, when you redeem, similarly, the original investment plus the return on it converts back into Indian rupees and comes back to your India account. So if you have, say, let's take an example now to make it a bit easier to understand. So if you have sent your original investment out by paying, say, 68 rupees to the dollar, which is what it was about 3 years ago, and redeem and bring it back today when the number is more like 78 rupees to a dollar, it effectively means that you have made an additional return of about 10 rupees per dollar of investment that you've made. And this is not a small number, Alex. So it would have added approximately 15% in 3 years over and above whatever your actual underlying investment has given you. So it kind of acts, international investing acts as a natural hedge against the rupee depreciation. And that's really important to us Indians who are seeing a depreciating currency, which means that there is then actual erosion in our purchasing power. And this year alone, we've seen the rupee depreciate close to 4.2% against the dollar, with the worsening risk sentiment. So that's, a significant amount of additional return that you can get. And we're not just talking about this as a short-term trend. When we look at, say, the last 25-year data, you will see that the INR's average depreciation, and I'm not saying this is a steady straight line, but the average depreciation over a 25-year period has been about 3% against the dollar. And like you rightly pointed out, it was interesting that at independence, it was 4 rupees something to buy a dollar, and today that number is 78. So that's the kind of, real depreciation that we've seen in our lifetime. And as a result, that has a very significant impact on investing. So what does this mean, and what should you do as an investor? And this is where we say that while you cannot predict in the short term what is going to happen to the rupee dollar movement, certainly history as well as theory tells us that in general, the currency of any country will depreciate to the difference between the inflation rate versus the US. So again, if we take numbers, the long-term US inflation is about 1 to 2%. That same number for India is more like 4 to 6%. So when we look at the differential of 3 to 4% between the inflations of the two countries, we can safely assume that the rupee will depreciate in the longer run, if you give it, a cycle, against the dollar by about 3 to 4%. And this, like I said, would not happen in a straight line, but one can certainly take an investment decision that if we were to allocate some part of our domestic money to international investments, we would get the additional benefit of, this depreciation that would also accrue to us.
Absolutely, Shalini. In fact, that ties in very nicely to what we've been saying on this program consistently, what advisors like yourself have pointed out. Allocate a certain amount of your investment portfolio into investments abroad. But thank you so much for laying the context. Lovely speaking to you as always.
Great. Thanks so much for your time. Thank you.